Hello, everyone. It's Ted Bauman here. I am at my home in Cape Town. I know I said I was going to be getting back on YouTube relatively quickly after I got here, but had actually quite a lot of stuff to do around the house. And so I have really taken a couple of weeks off from pretty much everything. Now, before I talk about the market today, I'm going to take a macro view of what's happened in the last couple of weeks. Just wanted to tell you that I've started a new job. I'm now working with a group called International Living, which is an organization that basically focuses on helping Americans and Canadians in particular who look to establish themselves outside the United States, as I have myself, since I am a dual citizen of the United States and of South Africa. The reason I mention this is because that's going to be taking up some of my time, but there's a lot of cross fertilization between what I do here in terms of my market commentary, my macro commentary, and the work that I'm doing for IL. For IL, really, I'm going to be looking at international investment opportunities and also personal diversification. In other words, what does it involve if you want to go and live in another country? How do you get residence in another country? How do you get a passport from another country? So I just wanted to flag that for you because this is not an IL video channel. This is me in my personal capacity, but you will see my name cropping up probably on YouTube and in other platforms as a result of my new engagement with that wonderful group, International Living. Now, today I want to talk about what's been happening in the markets since I last spoke to you, which was during the time of the SVB crisis or just after it. So let's look at some charts. All right, here's a chart of the NASDAQ 100. Now, the NASDAQ 100 is essentially all the big technology companies with some other big NASDAQ listed companies, pharma companies, and so on. Now, what I want to draw your attention to here is the two lines that I've drawn, the momentum lines. The red one is the 10-day moving average, and the green one is the 21-day exponential moving average. And I find them handy because they're pretty good momentum indicators. The two of them together help to illuminate short-term market movements. I've circled market action right around the 21st, 22nd, 23rd of March, and guess what happened then? That was when SVB blew up. Now, the interesting thing is that just after that blow up, the momentum, the 10-day moving average for the NASDAQ 100, i.e. the big tech companies, started to rise again, right? We saw a little bit of a wobble. Maybe it wasn't straight away, but by the beginning of the first week of April, certainly there was a clear indication that stocks were recovering, or at least these big technology stocks. Now, we know why that's the case. We knew that it happens because of what? Movements in the treasury market. So here's the 10-year treasury yield, and I've circled the same time period. And you can see that although the treasury yield had already fallen off very significantly after the beginning of March, that was when the Fed announced a 25%, or sorry, a 0.25% hike in their target rate. It fell again after the SVB issue, and that happened because the assumption on the part of the market was that people were going to, or that the Fed was going to stop raising rates in order to protect the banking sector, because SVB fell apart because the rise in interest rates caused their collateral to collapse, which meant that they became technically insolvent and unable to meet depositor withdrawals. So the assumption was, in order to protect the banking sector, that the Fed would slow down on its interest rate hikes. Then we saw a kind of a recovery in the 10-year Treasury yield. But then in the last 1, 2, 3, 4, 5, 6 trading sessions, it's been down, and very strongly down. The day before yesterday, I'm recording this on the 7th of April, Good Friday. So we're talking about movements on Thursday. So basically, the message here, I believe, is that the market believes that the Fed is done with interest rate increases, and that it kind of creates license to pile back into technology stocks in particular. Or does it? That's the big question. So let's have a look at the two overlaid. This is the NASDAQ 100 on the top, and the 10-year Treasury yield on the bottom. This is their percentage movements, their relative movements. Now, again, you can see that there's, as always, is a tight correlation between the two. At the beginning of the year over here, you can see that as the Treasury yield was falling, the market was recovering. Then once the Treasury yield began to pick up again, the market nosedived, or not really nosedived, but it went back down again. Uh, then, when there was a steep fall off at the beginning of March as a result of the Fed's slower than expected interest rate increase, there was then this upward tick. And again, since the whole SVB debacle, what we've seen is, or debacle rather, what we saw was an initial jump in the Treasury yield as people tried to move into cash. In other words, they basically wanted to get out of everything. They wanted to get out of stocks and bonds, and that led to a slight uptick. But since then, as things have calmed down, as the Fed has announced their rescue package, the Treasury yield has fallen, and as a result, the big tech guys and the growth companies are back on top of the game. At the same time, we've seen that volatility, which was very high during the first half of March, has declined again. We're back down to pretty limited volatility. I mean, it's basically the lowest volatility that we've seen. This is the VIX, of course, but this is the lowest that we've seen really all year. I mean, it's hard to see a period that has had less volatility than since the beginning of April. Now let's look at a couple of different sectors. Now this is U.S. S&P sectors, right? So at the very top in the last 1 month, that's what I'm showing you here, we've seen big jumps in communication, information technology. So those are the two that overlap with the NASDAQ. That's basically where you're seeing big growth in companies that had been beaten down during the course of last year and since the beginning of this year, and people starting to move back in. You can see that they are pushing towards the top of their 1 month price ranges. So it's been a good month for those kinds of companies. But so have defensives. The utilities are up, consumer staples, healthcare, discretionary. Those are all defensive sectors. And so they've also seen relatively good movements, particularly these three: utilities, consumer staples, and healthcare. So it's not all just about money pouring back into more speculative growth. It's also money moving into defensive sectors. And then further down, the kind of real economy based sectors like energy, real estate, materials, and industrials are all down significantly. But the biggest one, of course, that's down is financials. So part of what's happening here is that money's rotating out of here and rotating up into here, and some of it up into here. But remember, one of the things that has happened during all of this has been just a general decline in overall liquidity in the market, because people have moved huge amounts of money into money market funds, which are really a safer form of storage or cash storage than, say, bank accounts. So what's happened is we've had reduced liquidity in the markets, which amplifies price movements, because the smaller the liquidity, all of the things being equal, the more you tend to see increases or rather movements in either direction being amplified. That's just a natural outcome of reduced liquidity. Now let's look at the top 200 growth stocks. This is the iShares Russell Top 200 Growth ETF vis-a-vis the S&P 500. And again, although they tracked each other pretty closely, there was a market, the market kind of said it moved back into growth during February. Then we had that long decline. But look at how much gap has opened up between growth and the rest of the market since the beginning of March. And I would argue that all of this is due to anticipatory trading around the future direction of Fed policy. So the big question is this based on a realistic reading of where things are going? And I think maybe not. And here's why. This chart here shows the kind of industrial view as opposed to just sectoral view. And clearly what we're seeing is a lot of money piling into gold and precious metals, some piling into building. That's as a result of good reads from the construction sector earlier this year. But basically bond markets and precious metals have really seen the biggest gains in the last month or so. And what that tells me is that although people are, yes, putting money back into growth, they're also putting a great deal of money into the hedgiest hedges that there are, which is gold and precious metals. So there's still a lot of concern out there in the markets, and we cannot say with any certainty that the trouble is over. So let's just confirm that by looking at the current action in the gold price. The gold price had been on a long decline since the beginning of February, really basically uh, during the whole month of February, gold was declining, partly because yields on Treasury bonds were rising, and that made Treasury relatively more attractive. But then it started rising again, first because Treasury yields were falling. As after the Fed announced that 0.25% uh, rate hike in early March. Basically, the idea was that, well, if the Fed is going to dial it back, then maybe Treasury yields are not going to be so great. Let's go back into gold. Then we had the wobble around SVB, where everybody was trying to put their money into cash. But now look what's happened. Now they're going back to gold. And what that tells me is that right now there's still a lot of concern about the financial sector as a whole, B, the Fed's future intentions, and C, whether the global and US economies are in a position to be able to fight off a recession. I'm not saying that a recession is coming. In fact, it's a kind of a miracle that we haven't seen it. But there are still a lot of uncertainty around that. And lastly, let's just look at silver. Very, very similar action with silver. Silver, also being an industrial metal, is more sensitive to industrial demand, which means that it's not quite as much of a hedge for retail investors as gold is. But there's an interesting thing about silver, and that is that people tend to look at silver. They look at the price of silver and they think, "Wow, it's so low, it's got to go up." And there's a kind of an almost emotional and knee-jerk response to silver in times of crisis, that people pour into it thinking that it's going to rise as much as gold does. So there may be still some legs there in the silver market if you're so inclined. All right. So what are we to make of all this? Well, clearly, the markets have reacted primarily to problems in the banking sector. I didn't mention the problem with Credit Suisse, but clearly European contagion. There's been fears about contagion in credit markets, in financial markets in general, and that has led to a lot of money shifting around. Um, a lot of money has pulled out of the stock market and out of the banking sector and moved into money market funds, which are banked or backed primarily by treasury bonds themselves. And that has led to some paradoxical, um, movements in rates and in various asset prices. My sense is that we still are not in the clear. I mean, we still don't know whether we're going to be facing recessionary conditions. We don't know what the Fed is going to be doing in the next couple of months and quarters in terms of their financial, or rather their interest rate policies. But remember that the Fed's mandate is not to protect the banking system. It's to keep interest rates, or rather to keep inflation as low as it possibly can, and at the same time try to achieve full employment. Right now, the inflation rates are still relatively high. We're still getting fairly high prints in inflation. So for my money, one of the biggest inflection points to watch is going to be the next monthly inflation print. That'll be the price print for March. When that comes out, that's going to be a big turning point in the market, because if inflation comes in lower than anticipated, if we see a significant drop in inflation, then I think you could see some stocks taking off. The question is whether or not that is still sustainable. And I still believe that you really got to pay attention to things like the price to earnings ratio, because ultimately we still have not shaken off all of the excessive PE growth that we saw during the post-COVID period. We still need to get back to reasonable PE rates. And so I would look for stocks that are trading below their sectoral average in terms of PE, and that's where I'll be putting my money. This is Ted Bauman speaking. I'll be back hopefully within the next week or fortnight with another video, depending on movements in the market. And remember, I'm now part of the International Living team. So toggle over to www.internationalliving.com and you can see what else I'm doing with my life. Ted Bauman signing off. I'll see you soon.